everyone. Welcome to the Monday Dividend Cafe. We are back in it, going around the horn, all of our normal topics. And there's a fair amount of fun things today, but it's not an overly abundant a listen today. So you may be in for a treat. I may get you out of here a little early, but nevertheless, some fun things to share. I'll first say that if you missed the Dividend Cafe on Friday, it was the first, and I would like to think the last time that I've done a deep dive treatment into our approach to Bitcoin and the crypto world. The Dividend Cafe on Friday, if you want either the video or the podcast or the written commentary at dividendcafe.com, feel free to check it out for my comprehensive treatment as to why the Bahnsen Group doesn't own and never will Bitcoin. Today, here in the Dividend Cafe, we are focusing on the normal categories that we like to cover, which is the markets, the Fed, housing, public policy, economic data, and so forth and so on. Let me start with today in the market. Dow is down a little bit over 200 points. It kind of just went down slowly but surely throughout the day. There were a few spurts and starts and ups and downs along the way, but nothing too dramatic. The Dow closed down 0.45%. The S&P closed down 0.35%. NASDAQ down 0.14. There was only one sector in positive territory, and that was technology, which was up 93 basis points. But then the worst performing sector of the day was its cousin, communication services, which is actually an offshoot of a sector from technology, and it was down 1.77%. So when you see something like that with communication down quite a bit and technology up a decent amount, and that big disparity between the two, it's usually because there's a couple major companies, one where a couple companies went one way and a couple went the other, and it pulled those two sectors in a different direction. The bond market, I think, is a bigger story right now. Not just today's action. The 10-year was up just 3 basis points, the yield. And so bonds were off a little bit more today as the 10-year closed at 4.17%. But this does represent 12 basis points over the last 3 trading days. So that isn't anything to be concerned or over responsive to. But I will say that having the 10-year move higher while the the odds of the Fed cutting rates are growing even more. And while inflation expectations have not moved a bunch, this is sort of in line with a little bit of a pro-cyclical trade. You've seen financials rally. You've seen some of these semiconductors come back on a little bit. So I would think that so far the movement in the 10-year is mostly in line with a little bit of a pro-cyclical optimism. But again, it's only 12 basis points, and bond investors have been having such a good run that they are probably sitting okay to see the 10-year move that way in a few days. But we're watching it and curious what else it may indicate. What I also point out across the yield curve is that the 1 month, 2 month, 3 month, 6 month, the very short end of the yield curve are all at a higher yield than anything past 6 months all the way out to 5 years. So you have this strange inversion where yields are higher on the very short end, then they drop for a few years, and then they get a little bit higher at about the 5 year mark and slope out from there accordingly to the 10 to the 30. So the kind of most sloped part of the curve is almost more like the 2 to 10 than the 3 month to 10. And that's not normal, but it is very normal if the Fed is making a policy mistake. And that's kind of what the bond market is saying, is that the ultra short part of the curve should be lower, meaning the Fed funds rate should be lower, to reflect a more healthily shaped curve. The Fed will, it appears, be cutting rates this week. We're at about a 90% probability in the futures market of a 25 basis point rate cut. That normalization back to expectation of a rate cut came a couple of weeks ago. It had gone the other way after the late October FOMC meeting. And then about halfway between the two meetings, John Williams from the New York Fed came out to blend his argument for why the Fed should cut again, and all of a sudden things move the other way. So we'll see what Chairman Powell says at the presser this week, the Fed meeting tomorrow, and then again Wednesday, making their announcement where, again, all indications very nearly 100% are that they will be cutting rates another quarter of a point this coming Wednesday. Other issues in markets, I would just point out credit spreads tighter than they have been, even as equity volatility has picked up. Credit spreads have narrowed a bit. Levered loans, high yield bond spreads have come in. You're not seeing a widening of risk spreads, which you would expect if we were having a more broad risk off environment. Um, Now, it's entirely possible that all we've seen in equities with this enhanced volatility was more sector rotation and a repricing of one particular sector. But even there, we saw a sell off in semiconductors, and then you've seen a rebound in some semiconductors, but not others. So it's a real mixed bag right now. And even something like a day where the top performing sector is technology and the bottom performing sector is communication services, it does speak to a little bit of the just oddness that is playing out in markets right now. We'll kind of wait and see how things sort of coalesce in the days and weeks to come. What else? Just finally on markets, post financial crisis. I thought this is interesting that from post financial crisis, let's call it 2010 to 2020, that decade, the Russell 2000, the small cap index, averaged somewhere between 25 and 30%. That was the range of companies in the index that were losing money, that had negative EBITDA. And from 2020, 2021 through current, the last 5 years, that number has gone up and down between 40 and 45%. A significantly higher amount of the constituents in the Russell 2000 small cap index are companies that have negative earnings. And so I do think that this is one of the reasons that you've had enhanced problems in the relative performance of small cap to big cap. But I also think it speaks to the importance of more selectivity versus a high beta focus when one is investing in the small cap space. So let me go around the horn with our normal categories. The news story of the day I'll focus on is President Zelensky of Ukraine in London today, meeting with European leaders about the next steps as far as this ongoing negotiation that's largely been led thus far with U.S. negotiators in Russia, and Zelensky meeting with European leaders to discuss their own fate and response to this proposed negotiation. There's a link in Dividend Cafe reflecting this, but I think it was a big news story that came out Friday regarding Netflix receiving a winning bid to purchase Warner Brothers Discovery. There's a pretty lengthy process to close the deal for shareholder vote and for regulatory approval in front of them, but such a large breakup fee in the deal that there is a high degree of confidence from both parties that this deal will close. But then today, first of all, you had a weekend of the White House expressing their own trepidation about the deal. And then today, one of the competing bidders, Skydance, which recently bought Paramount and CBS, went hostile with their own bid, meaning going straight to shareholders, since they didn't have the cooperation of management to try to purchase Warner Brothers themselves. I don't, generally hostile bids don't go anywhere, but this is a corporate news story that we intend to watch. We don't own any of the companies involved, but it has other both regulatory and general media apparatus reasons that we're interested in the story. On the public policy front, the president announced he's signing an executive order establishing one rule on artificial intelligence regulation, trying to eliminate state level policies on the technology. My best guess is that this will be going to the Supreme Court. Our Constitution does, talk about a 10th Amendment, and there is a certain amount of power delegated to states and their right to have their own regulatory treatment of AI. And so the devil will be in the details on a lot of this. Congress, of course, can pass certain regulations that states will be subject to, but they have not done so. So doing something by executive order that trumps the states' rights is unlikely to me. But nevertheless, it speaks to how important of an issue this is in Silicon Valley and where things stand right now in the really very cozy relationship between the White House and Silicon Valley. Very different than we saw in the Trump 1.0 administration. U.S. Trade Representative Jameson Greer confirmed that China has been compliant thus far with the new trade agreements that are in place and that they are reporting vast increases of their purchase of U.S. soybeans. So helping to kind of satisfy some who are worried about China's compliance with the deals. On the economic front right now, I would argue that the question around job health and what we're seeing in the jobs data is a very important one, but so is the cause behind what we're seeing. And so you, on one end, have a debate about how good the labor market is, but on the other hand, you have a debate about whatever we see in the labor market, what are the primary factors? And one school of thought is that the labor market is softening, but that it is not softening as a weakening demand, that there is not necessarily less employers wanting to hire more people, which would be a problem for the economy, but that actually softening because of weakening supply. That whether it be the government workers or more particularly access to immigrant workers, the H-1B visa issue, that's putting downward pressure on the data as it pertains to supply of workers. I don't know the full answer, but what I would speculate is that small business hiring has dropped a great deal, and that not all of the weakness, but some of it is related to changes in labor supply. In other words, there's a sort of splitting of the baby that probably gets you closer to the truth. Private sector jobs in November were negative by 32,000, according to ADP. We got in the report last week. The layoffs report from Challenger Christmas Gray came in with 71,000 layoffs in the month of November, 1.7 million layoffs year to date. That's a 54% increase from the year to date number a year ago. Last night, we found out that China's trade surplus is now over $1 trillion. So their exports globally are clearly not being hurt by the U.S. trade activities. That was one of the rationales for the trade war, is to kind of diminish China's role competitively. And what we see is that their exports are actually up 5.9% on the year. This isn't so much related to housing and mortgage. Sometimes I throw anything kind of commercial real estate, commercial mortgage, not to mention residential mortgage, and obviously multifamily and single family housing. I kind of lump it all into one category here in the Monday Dividend Cafe. But just as a factoid, that was extracted from the SL Green report that came out last week. New York City office vacancy, which is most certainly up and up quite a bit from pre-COVID levels, it is 10% lower than Chicago and 20% lower than San Francisco. And New York's office market is larger than both of those cities put together. Both of the office markets of Chicago and San Francisco combined are smaller than New York's, and yet New York has a substantially lower vacancy than those other cities. Just for whatever it's worth, an interesting factoid. I already mentioned the Fed, 90% chance of a cut this week. One thing I will put out there is that the Bank of Japan, which doesn't meet this week, but meets near the end of next week, is all but assured now of hiking rates at their meeting. So you say, okay, wow, the Bank of Japan's going higher, the Fed's going lower. What is the 2-year rate in Japan? Moving higher, an 18-year high because of the Bank of Japan tightening. It is at a whopping 1.05%. Oil down over 2% today, closing a little bit below $59 a barrel. Utilities got hit hard last week. Infrastructure stocks were down. Midstream was actually up 1.3% on the week. MLPs were down a bit. Canadians okay, and then the corporate pipeline companies, the corporations did actually quite well. All right, there's an Ask TBG about whether or not I worry of the yen carry trade. creating kind of drawdown in stocks in the beginning part of 2026. I encourage you to go to dividendcafe.com, our homepage, to read the answer and ask TBG. I will be with you in the Dividend Cafe on Friday. As always, we have some very fun things in store for you in our daily recap throughout the week. And naturally, clients will receive their weekly portfolio holdings report on Wednesday. In the meantime, reach out with any questions at thebahnsengroup.com. And thank you for listening. Thank you for watching. And thank you for reading the Dividend Cafe.